So there needs to be some sort of transformation. We all learn over the last 15 years, cheap stuff can be cheap forever. In the last 15 years, it usually did stay cheap forever. So you want to find things that change.
All right, we're here with Roderick Van Zuylen, who is a hedge fund manager based out of Denver, Colorado. He is also running a publication called KEDM, which helps investors identify stocks. None of this should be taken as investment advice. It's purely for informational and educational purposes. And do your own research, please. I do not own any of these shares, but Roderick does. Very welcome, Roderick.
Thanks for having me. Been a big fan of Asian Century stocks. I think I was one of your first subscribers when you launched the thing. So yeah, big fan. Happy to chat.
Oh, thank you very much. Yeah, I've seen you on Value Investors Club. You were a long-time member, maybe 8 years or so, almost the same as me. And we also had shared interest, I think, in one of those Hong Kong very cheap stocks, Dream International. Anyway, it's good to finally speak to you. But first of all, to those who don't know you, maybe you can talk about your background. Where did you live growing up, and how did you get into investing?
Sure thing. So as you said, I'm in Colorado now. I moved to the US 2 years ago. Almost 3 years. I've lived in Amsterdam like the 10, 15 years before that, and always worked in institutional long-only management roles. And 3 years ago, had the opportunity to move to the US and live the American dream. So I'm splitting my time now between Florida in winters and the summers in Boulder, Colorado. When I moved here for 1 or 2 weeks, I thought let's just do the same thing as I used to do back in the Netherlands, which is get a job at a long-only fund. And after 1 or 2 weeks, I figured hey, starting a new phase of my life here, so might as well do things differently. If I'm ever going to start my own fund, this is the time. So I think within a week of landing in the US, wired a bunch of money to the lawyer, said set up a structure, and I launched Nightwatch. In the last PM role that I had, I managed a value fund and dividend fund. And I started Nightwatch as a value fund, very much catalyst driven. We'll get into all of that, but yeah, that's sort of been the last couple of years.
Cool. So before that, I guess you worked on the buy side. Was it in the Netherlands? Is that correct? And what did you focus on back then?
Has it
changed?
Yeah. So the last one was very institutional, Van Lanschot Kempen, which is the largest private bank in the Netherlands, and you manage a couple of billion, and it's institutional. There's an ESG desk looking over your shoulder, and there's a lot of people in the firm with opinions on what you're doing, even though you're the PM. And before that, a much smaller fund in the 400, 500 million euros range, which was the best learning school because it was a small shop where I set up a small research team in the time that I was there. And the founders of the firm had the attitude, if you want to go travel and meet companies, go for it. And that was pre-COVID. There were a lot more investor days with factory tours and all of that. So my work consisted of finding an investor day in Finland, for instance, and then finding all the other Finnish companies that I might be interested in and go to the office and figure out how stuff works, which is what makes this work so much fun.
Cool. And how about today? I mean, you were at Nightwatch Investment Management. What is it or how would you describe your strategy right now? What kind of stocks do you like to invest in generally?
So even though I'm calling it a value fund, valuation is never the starting point of any kind of investment. I'm looking for companies that are better companies a couple of years from now. So there needs to be some sort of transformation. We all learn over the last 15 years, cheap stuff can be cheap forever. In the last 15 years, it usually did stay cheap forever. So you want to find things that change. And I think there's two different buckets in what we're trying to do, and one of them are, and that's the biggest and the most exciting, is find industries where earnings are about to inflect. Find industries with very long tailwinds, where you can be invested in a certain trend for multiple years. Also becomes very tax efficient. And the other bucket is a little bit more stock specific. And you mentioned KEDM, the research business that I now run with a partner in the Netherlands. And that's just keeping an eye on companies where things change. Like in the old days, I'm an Excel nerd. I have Excel models on a few hundred different companies that I might not have looked at for years. And in the old days, a lot of my investment process existed out of people coming to me like, hey, do you remember this company we spoke about 5 years ago, or we both looked at 5 years ago, but we didn't like the CEO? Well, the CEO just left and he got replaced by someone new. And with KEDM, that's sort of been done more systematic. I have a team of data analysts that are on a weekly basis scanning through the investable universe of which companies have new CEOs, which spin-offs are happening at the moment, strategic alternatives, activists getting involved. So yeah, the bucket exists of companies where things are changing on a company level.
Okay, I'm curious about like how do you find those? Obviously, if it's a whole industry that's changing, that's pretty straightforward. For example, during COVID, certain stocks benefited from the reopening and such. But if you start from a spreadsheet with, let's say, insider buys, you have to go into each story, right? Each stock, or how do you go through that process to find those that will actually have inflecting earnings?
That's the difficult part. If it's stock specific and there's no industry behind it, there's just too many stocks.
Yeah.
If you do this work for 15 years, yes, there's a few hundred stocks that you've looked at in the past, and you're adding a couple of, I mean, you're adding dozens to that list every year. You go to a conference and you speak to 15 companies over 2 days, and 10 of those are new. So you're adding to that list. But yeah, if it's company specific, there's too many of them. That's
Yeah.
why I really like that first bucket, where I don't know at the moment or the last year I've been really bullish on anything in aerospace aftermarket, just because the global fleet of airplanes is aging. Airbus and Boeing can't keep up with the required production. So there's more demand for maintenance, and anyone who makes money in the aftermarket and distributing parts or performing the maintenance is probably going to do well for another 5+ years. So I've been looking at a lot of those companies, and 5 years ago I spent an entire year on looking at the entire home building supply chain. And that way you just go through industry by industry. And I mean, we all do a lot of stock specific work, but at the end of the day, we all realize that I think 50% of the market move is just market beta, 30 or 40% might be industry beta, and the last 10-20% might be whether or not you like the CEO.
Yeah. Okay, so let's say that you have a aerospace related stock that you like, let's say a spin-off or something, and you're excited by it. Perhaps it's a low valuation multiple or something else that draws you to it. But how do you size that position from early on, and eventually how do you build a portfolio? From my understanding, you have quite a concentrated portfolio. Is that correct? Or how do you think about the position sizing overall and that process of building a portfolio?
Coming from my background as more of an institutional manager, I'm a lot more concentrated today than I was back then. If I look at all the YOLO crowd on Twitter nowadays, I'm not concentrated. Like most of my conviction weights are between 6-7%. I've got one position that's close to 15%, and part of that is performance. And when it moves over 15, I scale it down. I've never found a perfect answer to the sizing question. Size is a function of conviction and risk. And there's a lot of people approaching it in a very quantitative manner. The only thing for me that works is if I worry too much about a position, it's too large. You should size it to the point that it's okay if the share price goes down if you really like the story and nothing fundamentally changed. So it's not a quantitative assessment. It's pretty much more emotional than anything else. Um,
Yeah. Okay. What about VIC? I mean, you've been there for quite some time. I guess, when you read other people's write-ups, that was extremely useful for me in learning how to invest a little bit better. What would you say that you've learned from Vic during all those years?
there's some really smart people there. Um, I might have been on it for 8 years or something, and I didn't get on there by the first on my first attempt. It might have been my third or fourth attempt, and maybe at some point they took pity on me and let me in. But it's really changed a lot for me at the time. It's earlier in your career, and it's all about broadening the universe of stocks you look at. And nowadays you can subscribe to 10 different Substacks and have some idea generation there. And before you had that, I still think Vic is extremely valuable. But just the breadth of ideas that's being pitched makes it really interesting. And then there's the whole community, the comment section, the discussions you have. Um, you get some like a few hundred of the smartest buy-siders together, and they're all happy to share ideas. So yeah, it's been very useful.
Yeah, I agree. I especially like the feedback you get, the pushback to your ideas. There's always something in every of those pushbacks, I find, you know. Um, but anyway, let's talk about one of the earliest ideas that I remember that we spoke about, and that's Dream International. I think the ticker is 1126 Hong Kong or something like that. Um, you were involved for some time, then you sold, I believe. Tell me about that. I mean, what caused you to enter and then exit?
Um, so my Asian book is a lot smaller than my US and European book. And I think the framework for investing in China, for me at least, is a bit different. Like I tend to joke about our strategy would be to find guaranteed multi-baggers with no downside. But when it comes to Chinese companies, I just want a company that doesn't steal from you. Um, and they fit this bill. I tend to not look at dividend yields, but in emerging markets, it's different. Companies that pay out dividends, that's sort of the money that insiders are willing to share with all their friends who also invest in the company. You sort of accept that there's always a chance that in a controlled company like Dream International, 3/4 is owned by a Korean family, who have given no reason not to be trustworthy. But you just know, like whatever they pay out as dividends is money that's going to come your way. And Dream International, they make Mickey Mouse for Disneyland, among other things. They do a little bit more than that, but think of it as Disneyland, Tokyo, Shanghai, especially the ones located in Asia. So I got involved in it as a COVID recovery play, where Tokyo Disneyland was closed and they were about to open, and their business was about to take off again. Um, I try to talk to companies and management and Dream International. Like it's a tightly controlled Hong Kong-based company, but the CFO, which is the son-in-law of the founder, um, someone in his 30s, and he is approachable, speaks English. I like my conversations with him, but the core thesis was just a Tokyo reopening. I think the dividend yield at that time was like 13%. But they were hoarding so much cash, which they can't use for buybacks because they're at a 75% threshold. So I expected the payout ratio to go up quite significantly, from like 30% to 40 or 50%, which it did. So then it turned into a 20% dividend yield stock at my cost price. And it's hard to lose money if you make 20% in dividends. Then one day last year, I woke up and I think I've never been able to verify this. I think somebody somewhere on Chinese social media spread the rumor that they were also making Labubu. Um, which was hot at the time. So I think it was up, I don't know, 50%, 100% in just a week. Um, after um, well, it came a few months after the tariffs, and of course the tariffs were usually negative for this kind of business because they also sell a lot to the US. I mean, if a stock doubles on a rumor that I couldn't confirm, plus in the end, I think their revenues went up by a few percent because of Labubu. It was never anything material. Um, so yeah, sometimes you get lucky, and then it's time to look for the next idea.
Yeah, exactly. I think even if it was going to lead to something, I think there were discussions, but those were mostly rumored. So it was nothing concrete at the time. But but how about today? I mean, have you looked at the stock recently? Because I think the stock is down maybe 50% last 2 years.
Um, it's down a lot. It's lower than where I sold it. I'll revisit it at some point. I'm not in a rush.
Yeah. Okay. Let's talk about another Asian stock that you were involved with at some point. DPC Dash is a franchisor or sub-franchisor. Is that what it's called? I guess they have
Franchisee.
franchisee, but they also have franchisees of their own, don't they? In China? No,
I don't think so. A lot
I don't
of
think so. Okay.
there's like 6 or 7 publicly traded Domino's companies. And I
Yep.
think in the UK, the model is to be a franchisee and then sub-franchise to others, which you can, if the unit economics are strong enough, you can do that. But in China, for now, they don't sub-franchise. So they run the 1,500 stores that they have at the moment.
Yeah. It sounds like a good story. I mean, I know that Domino's Pizza has done really well in the US over the last 20 years. And it seems like the white space for growth for them should be large. There are like, I don't know how many KFCs there are in China, but over 10,000 at least, right? So do you still believe in that story in terms of like the overall TAM for Domino's Pizza, or has something broken in the story?
Um, I've been involved for about a year. Um, So the other part of the Chinese shares framework is find a management team that doesn't steal from you. And the problem with a lot of Chinese companies is that industries tend to get oversupplied. Consumer demand for certain things can be really good, but it's a country where you get 100 plus electric vehicle companies, because there's always funding for those things. And I think the restaurant sector might be one of the worst. I think you've been involved in some Hong Kong-based fast food
Yep.
chains, and it's a low margin business. There's margin pressure because wages go up, and there's always copycats. Everything that works. Heidi Lau, I think, was the most popular hot pot restaurant, and those shares went to infinity for a while or close to infinity, and came all the way down because it's not that difficult to make a competing hot pot model. Um, so it sort of went against my rules to buy into DPC Dash. I met with management and 2 people in the board of directors. They visit the ICR conference every year in January in Orlando, and the story resonated with me. So I lived in Beijing in 2008, 2009, and at that time, yes, KFC was everywhere. They were owned by China, and there's Pizza Hut, and I think Pizza Hut today is at close to 4,000 restaurants in China. And the way I remember Pizza Hut is Chinese students go there because it's next to their university, and they sit down there for 4 hours. They don't eat pizza but chicken wings, and they just study there for 4 hours, and because you have to study somewhere. So that's the Pizza Hut model. And of course, Domino's is different. It's you don't sit down, you pick up or you get delivery, and it's high volume. And it's one of those models. Gross margins on pizzas are extremely high. If you can do volume, you have a very profitable business. The reason DPC or Domino's wasn't in China 20 years ago was because KFC and Pizza Hut had their parent, the franchisor, invest behind the brand to build a brand. And China's a big country, and it turns out if you don't have at least 500 stores in some of the big cities, you just don't have the brand recognition that you would have otherwise. So Domino's didn't take off because their philosophy is the franchisee has to pay for all that growth themselves. And it wasn't until Domino started investing in that brand and get them to that 500 store critical mass that it really took off. And I like to joke in China, the Chinese people that I know, they like to stand in the longest possible line. If they see a line somewhere, they'll join it because whatever people are queuing up for, it must be really good. And that's sort of what's happening with Domino's, where if they open a new store in a new city, there are videos and their stories of lines of 4 hours plus for the grand opening because everybody wants to try it. And they've got like a localized pizza offering. It's still surprising to me because I thought most people in China are lactose intolerant and pizza isn't the best thing for them to eat. But as long as people are in the line for those things, people like it. So you got a business that at the time had 1,000 stores. Now they have 1,500 stores. They're adding 350, I think, this year. So there's like 20 to 30% unit growth, and the unit economics are incredible. I think it costs on average $200,000 to build a store, and it's 100,000 of EBIT per store. So it's like a 50% return on investment. That's pretty good for a model like that. So yeah, if you have that sort of return on capital and you're growing 30%, and you're in a market where these kind of things can go to very high multiples before copycats step in, it can get interesting. I changed my mind on the stock and I'm out of it now. If you listen to management, they would tell you that same store sales growth are disappointing. Like if on day one there's a line of 4 hours, then the next year is always going to be weaker than the first year because you have your honeymoon period and then you have like a stabilized store. And that's why same store sales are coming down, which is something, it makes sense what they're saying. And of course, if a city has one store and the next year they have 20 stores, they cannibalize a little bit. It makes sense that it's coming down. What really started worrying me is when margins started getting impacted from that. If same store sales go down and there's some inflation, not a lot, but there's wage inflation, your margins get squeezed. And those unit economics that I just mentioned might no longer be there. Like we are talking about not on a store level, but on a group level, like a business that does 4 or 5% margins. And if your margins go down by 2%, you do have a problem.
Yeah, I don't really understand the unit economics of making 100,000 in EBIT, and then somehow you end up with margins that are, so cutthroat or very thin. Yeah.
Because there's corporate overhead, and it's very difficult to figure out how much of that corporate overhead relates to growing your store count by 400 stores a year, versus if you were to just run it at sort of a stable level. And there's definitely a lot of scaling in that overhead as well. So you're growing into what could be very interesting profitability. But right now the profitability is on a store level and not on a company-wide level.
Okay. What will it take for you to re-enter the stock? Just curious. If you see same-store sales, accelerate again, would that be enough to get you excited?
Maybe same-store sales are going to get worse before they get better, and that's just based on the cohort of this year is going to enter the full cohort next year. It is really cheap. I think you are paying like $300,000-$400,000 per store, and one of those stores can do 100,000 in EBIT. I might revisit, but like I said, I broke one of my rules by investing in an industry that's not supply constrained. It's always gonna end up getting oversupplied. The margins are gonna come down. And when I realized it didn't work, I was out.
Yeah, well, yeah. Tell me. I mean, I owned Café de Coral for many years. It was it was a terrible experience. Very, if margins go up, I mean, if labor costs go up just slightly, the margins can get pressed so much. Obviously, that's a different market, but yeah. So how about casinos? I mean, I think you mentioned that you own casinos right now in Macau? And that's interesting.
I
I mean,
do.
yeah,
And the very simplistic way of looking at China is if every industry ends up getting oversupplied, there's a couple of exceptions to that. And one of them is casinos in Macau, because there is only 6 different operators with a license to run a casino. Um, and even they can't really grow the number of tables that they have. They can pull some tricks and get more people on the same gaming table, but it's a supply constrained industry. And at the end of the day, if the Chinese consumer makes more money, Chinese consumer isn't doing so well at the moment. But if they make more money, a certain portion of that leaks out towards Macau. So that's sort of the very simplified look at that industry. And of course, it's an industry that's had 2 regulatory crackdowns in the last 10, 15 years, just because it's a way for capital to leave China. And all those crackdowns meant there was a big step down in the VIP market, which I think is a market like the people gambling the big money. And now it's the mass market that is recovering, and I think better than it was in 2018, 2019, before the last crackdown. And when we're saying mass
is it
market, I think
possible to get
the
a sense
minimum
of,
bet size is still like
yeah,
$500. Sorry.
yeah, okay. Is it possible to understand how much VIP revenues are still there or are still, let's say, risky in terms of potential future crackdowns on, let's say, they used to call it, I think, like parallel betting. You would have people inside China, have people in these casinos making bets on behalf of people onshore, and then junket operators would then facilitate loans and the payout, help the gamblers get Hong Kong dollars from the casinos. That's happening everywhere in Asia, by the way. I mean, also in Manila and in Cambodia. And that's something that concerns me a little bit. But do you think that VIP revenue now is free from such issues?
China is probably never free of such regulatory risk. But yeah, as you said, it used to be the junket operators, difficult system. I got a tour a few months ago in Sense, Macau, where they just explained the whole system and how it works. And you'll know this better. You spent all your time in the region, but I think someone in mainland China would go to like a tour operator or a junket, and they would organize a trip to Macau, and they would get their money to bet once they were there, which was funded to them by the junket operator. And those junket operators aren't allowed anymore. But at the same time, I hear Sense China complain about the agents that some of their competitors have been using to gain market share. And I might call it agent, but it sounds like very much the same thing. So I think VIP is at like 30 or 40% of what it used to be in revenues. And there's always going to be like some money was already offshore, right? If money is already out of China, you can go to Macau and bet it.
Yeah.
But yeah, there's always some risk.
And there are also always ways to get money out of China. You can also use over-export, I mean, invoices at the wrong prices to get money out. I think that's the most common way. And also it's a way to get a lot more money than you could make, through these junket operators. But okay, let's talk about another stock that you mentioned, Futu. Is that a stock you own right now, or a stock that you've been involved in the past?
I've been involved in since quite recently, and I think it's the perfect example of. So it's one of the Chinese stockbrokers that allows Chinese people, and they've expanded into the broader Asian region, or actually global. But traditionally, it was a Chinese company that allowed Chinese people to buy Tesla or whatever, non-Chinese stocks, preferably with leverage. And the Chinese government cracked down on that in, I think it was 2021, 2022, because this was one of the ways to get your money out of China. Using your RMB to buy Tesla is a form of capital flight. And the reason I started getting involved,
Just to clarify, do you think that they helped their customers get the money out of China, or was it just the fact that they received eventually the money ended up in their bank accounts
I think
or brokerage
the
accounts?
moment you hold a Tesla share, then effectively it's in the country's capital account, right? The capital flight has already happened. If you deposit renminbi and you
Yeah,
buy a US dollar denominated stock,
right. So I guess the latest crackdown was about marketing their products to mainland Chinese customers, of course. Was that the issue? And are you not scared that they will have to divest of the shares in their brokerage accounts that are in there right now, and then potentially
they will
reduce the
have
amount
to.
of? Sorry.
They will definitely have to do that. So
Yeah.
in 2022, the business was in trouble because it was a Chinese business that was no longer viable. And then in the last 5 years, Futu Up Fintech, the Tiger broker, they've both done a really good job in building a non-China business. Futu's strongest market is Hong Kong, which is their core market, but they're large in Singapore. From what I understand is if you go to a grocery store, they'll both be there with a little stand to try and get you to open a brokerage account. So all of a sudden, it's a Southeast Asia business, and any kind of exposure to the Southeast Asian consumer could be a good business. And there's a lot less regulatory risk in Hong Kong and Singapore. So that's why I started getting involved. Then, of course, earlier this year, the share price came down. Nobody knew the reason, and then it turned out that Mother China cracked down on the whole business model again. Um, that came as a shock. Share price crashed. Some people clearly knew about that beforehand, and that's why the shares had been under pressure for the entire year. But what I think happened is there were still two ways. If you were in mainland China right now is like 20% of their revenue, maybe 30% of earnings, but it's a smaller portion. So yes, if that business goes to zero, you take 30% out of their EPS, and then you have a low risk, high growth Southeast Asia business that I think is worth a much higher multiple than the 8 or 9 times that it trades for today. But for someone in mainland China, there were still two ways to open a brokerage account. One, you had to show them that you had a Hong Kong ID, or two, you had to show that you already had a brokerage account, a foreign brokerage account. If you could show them that you had a interactive brokerage account, you could go to Futu and open a Futu account. And apparently, a lot of people just made fake PDFs of, "Hey, this is my interactive brokerage account," and that is no longer allowed. What they used to, like, they're now moving from an ID-based verification, like show me that you're allowed to live in Hong Kong, to a location-based. So right now, if you are physically in China, you can no longer trade, and that's the requirement by the government. So technically, someone from China can still take a bus to Hong Kong and trade in their Futu account. Will they actually go through all that trouble just so that they can gamble on stocks? I don't think so. I'm putting a zero on the Chinese business, which I'm happy if that's actually the case, because that's where the regulatory risk is. And I want that other 70% of earnings that's been growing at 60% over the last 5 years, right now it's growing like 30-ish%. But that's the really interesting business to own. And I'm happy to be the China risk.
Interesting. Yeah, I can tell. I mean, at least in Singapore, their business is very strong. I think I've spoken to customers of Momo, and it's very slick app and user interface, and I can tell that they're growing very fast for sure. I don't know if if it's expanded beyond Singapore, but at least in Singapore, they're doing it very well. That's for sure.
And at the end of the day, the investment thesis of all those online brokerages, whether it's Interactive Brokers, Robinhood, or Flatex, the Giro in Europe, it always was the switching from your legacy bank, which overcharges you for everything, to something a little bit more modern. And my impression is that move in Asia is a little bit behind what it is in the West. Like we've seen that over the last 20 years in Europe and the US. And I think there's still a lot of wealth stuck at HSBC, those kind of banks that is still moving towards online brokerage. And of course, it's one of the stocks I worry about when I see everyone in Korea blow up on levered SK Hynix ETFs, and I know that the customer base of Futu likes to gamble as well. So there's a bit of a cyclical risk that concerns me. But
yeah, okay, makes sense. It's a very scalable business. And another scalable business that I've been very interested in is Integral in Japan, the private equity company. And I've read the Vic write-up, and there's been write-ups on Substack as well. It always seems very compelling in terms of valuation. You can do a napkin math, and it just seems like a no-brainer. But for some reason, the stock hasn't really moved up. Just curious to hear what your view is on that. Because, in terms of capital allocation, they've performed extremely well. Their funds, at least, right? So the management company should be very valuable, you would think.
Exactly. So for those who don't know Integral, and it's not the best known stock, it's a private equity model like a KKR, but then Japanese. And the way I come into this, I like to play thematics, industries with tailwinds. And you had a very good write-up or a guest post in KEDM a while back on Korean corporate governance. This is on Japanese corporate governance. I think there's a lot of value to be found in small Japanese companies. If all of a sudden you can convince management to improve their capital allocation. And there's so many Japanese stocks, small companies, that I can never track all of that. So I need a higher beta way and an easier way to play that trend. You can also sign up for Asian century stocks and figure out which small caps to buy. But for me, a private equity model, a company that's done a lot of management buyouts of those undervalued stocks is a good way to play it. And stepping away from valuation, yes, it's cheap, but that's never my starting point. What makes this interesting is, if you just look at a couple of deals that they've done. I have one friend who had a position in, I think it was it Shinoken, the real estate company that got taken private, a management buyout, and everybody felt like they were getting a really bad deal by Integral buying it off their hands. Like all the time, every deal you see happening, they seem to be doing some really smart things. Text-sent photo mask, something in semiconductors. I would never be able to fully understand what they do. But I think it's been a 5-bagger or a 10-bagger in the last couple of years that they bought it, and they IPO'd it earlier this year. So they do very accretive deals, which means it becomes a lot easier for a private equity company to raise capital. And last year, they grew their AUM from, I think, 160 billion Japanese yen to 400 billion in 1 year. So that's 150% growth. The problem with that is you can raise a flagship fund every 2 or 3 years. So it's incredible growth every 2 years or 3 years. But in the meantime, it steps down.
What's the next big step up?
I think they will start raising capital at the end of 2027 for the next flagship fund, and I expect that flagship fund to be 2 times the size of their latest flagship fund. So I think 500 billion for that fund versus the 250 that they raised for Fund 5. So that's a big step up. And then,
did the stock react to the fundraising, the past fundraisings?
I think like 2025, their management fees, their management fees were negative after costs when they were the smaller scale, and that stepped up last year, and I think it reacted positively. But I haven't fully figured out. It's a low float stock. I haven't fully figured out what makes the stock move. I feel like if tomorrow they announce another IPO of one of their holdings, like when Tex and Photomask got IPO'd, it moves up another 30 or 40% in a week. And then attention shifts elsewhere. Most importantly, I think their AUM is going to be a lot higher. The other thing in private equity is once you build a reputation around private equity funds, you start raising a credit fund, real estate fund, VC fund, and you use that branding to grow your business. I mean, KKR, Blackstone, they've been incredible businesses, and I think they are trying to grow their Japanese business. It's just it makes a lot more sense to invest with the locals versus the US based companies. They have a bit more goodwill when they want to do not so much a hostile takeover, but a friendly management buyout at depressed prices. And then the stock itself is really cheap. They've been growing the value. They co-invest in their funds, and that value has been growing over time. And right now you pay like 10 or 20% premium over the book value, with no value being put on the management business, which is growing AUM by 100% every 2 or 3 years. So yeah, it's really cheap. It's also, I think there's 3 different tiers on the Tokyo market, but you're the expert, you'll know better. There's the prime, something in between, and then there's the growth market. And they are in the lowest tier, and the most important reason is the limited free float. When they IPO'd, the management team gave them a 5-year lockup. So it's like what SpaceX is doing in 1 month, they did in 5 years, which is good alignment with shareholders. But I think the first tranche will unlock later this year. I think it's good if the free float goes up a little bit, and eventually they'll move up to the prime market. And just you need a bit of size. Like none of the Japanese small caps seems to be trading anywhere near intrinsic value, I think.
Yeah, exactly. For the most part, it's because of poor capital allocation or some issues that prevent value unlock, like poison pills or cross holdings that prevent activists from coming in. But I think maybe Integral is better in terms of capital allocation. Maybe.
Their capital allocation for the LPs is absolutely brilliant. They are large shareholders in the company, so I tend to think they understand what they're doing and they are incentivized to make the shares work at some point. I think their communication to the capital market is pretty good if you look at their investor presentation with one comment or one point of improvement. I've been talking to them about this, but at this point, the value of their balance sheet is like 80% of the market cap. And then you get to a point that you want to know what the balance sheet is actually, what it looks like. Show us which funds you invested in. Show us at what sort of multiple you're valuing it at. I'm pretty sure that they're conservative in their valuation. Why not show us? So there's some points of improvement there. That will be easy gains. I've heard of a larger shareholder who went to their office with sort of the same point. And no result. So I'm not expecting wonders there overnight.
Interesting. Okay. All right. Okay. So let's talk about KEDM. You took over KEDM late last year, right? What was the reason for taking it over? And could you explain, to people who don't know, what exactly is KEDM about?
Sure thing. So KEDM is a research subscription business that was founded by Harris Guppy and his team, and they deserve all the credit for building that 6-7 years ago. And their reasoning at the time was it happened so often that you come across a situation like a spin-off that happened last year, and you look at it now and it's worked really well, and you just think like, well, that was a layup a year ago. I just didn't know about it. So they thought they should start flagging those things earlier, just to find the really easy layouts. And that grew into a very interesting subscription business. Like I said, there's an external team of data analysts that are putting 100 pages together, and then there's a team of fundamental analysts getting the most useful signals out of there. But anyway, Guppy got to a point where it was time to pass on the torch, and his fund has been very successful in the last 5 years, and his attention shifted to making it even more successful. And he and we both need it. It's an important part of his investment process, and it's become a very important part of my investment process. So we had to keep that team going with get us the data. And that was always the priority, find alpha generating ideas. So then we and a partner in the Netherlands, Tofcap, who had the Tofcap Monday Monitor, which was also an event-driven newsletter. We integrated the two, and that's how I see it. We took over the torch, and the product as it stands today is still very much an event-driven monitor, which flags the kind of events I pointed out. But there's also weekly thematic items, which is we've been talking about whether it's Macau casinos or aerospace aftermarket, just because that's the way I invest, and I think it's the way Capi invest. Try to find the big themes that you can get behind for the next couple of years. So there's, I think, a very interesting macro write-up every week. We try to make it very interesting. I think there have been some really good calls in the last couple of years. So it's sort of twofold. It's macro and it's event-driven.
Interesting. Can you provide any examples of ideas that you found via KDM over the past year?
Yeah. Everybody who's been reading it or who has been listening to me on social media or something, I'm joking that we sort of turn it into a Marex newsletter, which is the largest allocation in my fund. It's something I've been quite vocal about, but also something that I first learned about from KDM. It's a futures commission merchant. Think a broker, the guys you call if you want to trade commodities. And they IPO'd a little more than 2 years ago. After they tried the IPO a few years before in the UK, and that didn't work because nothing in the UK works. So they IPO'd in the US 2.5 years ago, and that's when it was on my radar, and that's when I got involved. And KEDM has sort of been tracking it through the last 2.5 years, and have been a lot of I think it's a very interesting industry, like a macro trend, because it's a consolidating market with growing demand. We're trading more futures every year, and there's fewer people who can trade them for us. But there were some event angles. There was a short report, which put some pressure on the share price, which was in hindsight completely wrong, something that KEDM covered. And there was private equity still involved after the IPO. Generally, you shouldn't get involved if private equity is selling during an IPO. I guess this was an exception, but they had been selling down in tranches, secondary placements or private placements over the last 1.5 years. And they sold their last tranche half a year ago or a little less. And it's no surprise to every time that they sold at 10% below market has been a great buying opportunity. And private placements, that's something that KEDM covers. And of course, when private equity sells their last tranche and the overhang disappears, then that's a buying opportunity. That's something we've been all over, but there's been a lot. Aerospace, nicotine pouches, European defense. Written a lot about the payment sector. And I actually think there's been great opportunities, and that's been working the last weeks in just boring quality compounders. So we've been writing a bit about that. But there's been a lot of themes. For-profit prisons. We wrote a lot about that earlier this year. It's worked incredibly well. Unfortunately, I didn't invest into it, but it's done really well.
Is there any broad theme that you would want to highlight that hasn't really fully worked out yet? For people who want a theme to look into right now. Just curious. Obviously, defense stocks have gone really well, for example, and presumably Marks as well. Is there anything that you would want to highlight?
And refiners are doing really well at the moment as well. So one of the more recent themes we wrote up, I'm a bit hesitant. It's very much all the credit here goes to Capi. He got this. He's still a contributor to the macro ideas. Like I think he's got some of the best big picture ideas that I've come across. But we're writing about trade schools. So that is UTI and Lincoln Education. which were actually companies I was involved in 6 years ago, sold out, and it took me. It was a big struggle to really pay up right now to get involved in a story I was involved in 5 years ago. But in general, they are the trade schools where people go to learn how to be a welder, a car mechanic, or a nurse or a dental hygienist. And I think demand for those kind of jobs. I mean, there's a shortage of people with those kind of skills. Has been for a couple of years. You can all argue whether that's going to get better or worse. If AI is going to come for all of our jobs, and maybe we all have to do something useful in life, such as being a welder.
We can go to UTI then, and then pay them fees to learn,
Exactly.
to learn a trade.
And what always kept me a bit cautious, I'm new to the US. I don't know completely how, or I had to learn how the education system here works. But my big concern was always like, how does this compete with community college? Like, why would you pay UTI $30,000, $35,000 to learn how to be a car mechanic in the next year? If a community college costs $8,000, but it's probably mostly covered by a Pell Grant or something. So I had to learn all of that, and whatever it is, and I think most people that want to be a welder don't want to spend half a year having to take English classes at first. But everybody's got a friend who's working as a welder who is making $100,000 plus, a lot more than he was making a few years ago. And if you can finish your education in 1 year versus 2 years, and you can skip all those English classes, and part of that 30,000 is a student loan or a Pell Grant. It's a very good very good opportunity for everybody taking one of those classes, and it's getting better if the salaries of welders goes up.
Okay. All right. If people are interested in KDM, where can they go to learn more?
That's easy. KEDM.com. There's free trials. There's a KEDM Pro, which is the product I pointed out, and there's a KEDM Lite, which is what used to be the TOFCAP Monday monitor. Yeah, get a free trial. Doesn't cost you anything. You get 4 weeks of content, and I think you like it.
Fantastic. How about yourself? Like, do you post on social media, or where can people find you if they want to contact you?
I post some on social media. If I have anything interesting to say, I'll say it through KEDM. Of course, I put a lot of effort into the quarterly letters from Nightwatch. That's Nightwatch IM from investmentmanagement.com. I try to make the letters informative, entertaining. You can sign up for that and get your quarterly letters. So nightwatchim.com.
Cool.
Yeah.
Well, thank you so much for taking the time, Roderick, and yeah, best of luck with everything.
Thank you so much. Really enjoyed talking to you.
Likewise.